Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes. All right, so the markets are really doing kind of what we've been talking about, basically doing nothing. And we do see, if I just take a quick peek, the VIX index is hanging in there. I'm kind of proud of it, honestly. We currently see the VIX trading at around 1850. Remember, we did a VIX trade going into the potential budget talks, well, the budget talks that the U.S. government was having and the potential shutdown of the government because of those budget talks. And we did see the VIX take a spike up above the 20 level. The government kicked the can down the road, and then they kicked the speaker out of the house. So the marketplace, I just kind of feel like it's not going anywhere. If anything, you're a little bit more nervous to the downside, and the VIX is showing that. And kind of proud of the VIX for that. I was disappointed going into that the big weekend, the end of September, beginning October weekend, where the new budget policy was supposed to start on October 1st. And the VIX was still trading right around that 16 level. And we even saw the VIX of the VIX, the VVIX was trading down around 88, 87. So in my mind, those were both low numbers. And so, yeah, I was really confused by that because this was a big event. I mean, if the government shuts down, it hurts the economy. And there's no doubt about that. And we saw that actually by looking at the VIX or at the Fed Fund Watch over on the CME website. And we actually saw the probability of a rate hike drop precipitously in the November 23rd meeting. The probability dropped all the way down to about 12%. We've had some good economic data where good news is bad news type scenario. And now we've seen that probability go back up towards that 30% level. Okay, so November, I think 11th is the drop dead date. I did write it on a note, but 45 days from when they kicked the can down the road. Pretty sure that was November 11th. And with that said, I'm still nervous with the market. The VIX is showing that we're a little nervous, still nervous about things. We went out, we sold a call spread on Monday in our paper trade. And I think that is a real solid trade to do right now. You find an underlying that you like to trade short spreads in, or an underlying that you may be bearish to neutral on. I don't think that's a bad plan. If you got some stocks that you've been holding and you're a little nervous about them, you can just sell a call against them. Try to bring in some premium. Now, you got to be careful. If you have a real low cost basis, you don't want the stock to be called away, and you're going to have to manage that position. And I'm going to actually show that in the playbook. We're going to pull up the playbook today, and we spend a lot of time in the playbook. But I want to give you some ideas on how to protect your portfolio going into this big day. You know, we got a lot of strikes going on. A lot of unions that are striking. We have the healthcare workers, we have the auto workers. There's probably a few more that are out there. We have a potential shutdown of the government, which means people aren't going to get paid. We have a student loan debt where people are going to have to start paying. And by the way, we still have a war in Ukraine. You don't want to forget about that every once in a while. And that's a big part of the budget talks. Some people would like to stop sending them money. Some people want to send them more money. So with all that said, I would like to use options for what they were first intended to do, to protect an asset. And that's where options came from. And if you really want to understand option trading, to jump back to the basics, you need to have that premises about option trading. I mean, there's a lot of similarities between the options marketplace and the insurance world. I mean, when you pay for your car insurance, you say, I got to pay my insurance premium. When you buy an option contract, that means that you're paying the premium for that option contract. They call the price of an option the premium. That's the correct vernacular to use when you're talking about option prices. And if you sell an option contract, you're referred to as the writer of the contract. If you buy an insurance policy, they say, well, We have to talk to our underwriters, and they are the writers of the contract, and they write that contract, and then you purchase it from them. So let's use options for what they're first intended to do. This is, I think, the first time on Options Guide TV that we have actually addressed protective strategies. And Options Guide TV is all about using real markets, real data, and trying to apply some of the 40 strategies that are inside the options playbook to the current market conditions. So I think this is the time. If anything, we looked at a VIX trade going into the budget talks, and that might have not been a bad time to actually talk a little bit more about insurance. But okay, so that's gone. We're here today. I'm going to look at one of the most widely held positions at most brokerage firms, and that's a little known company called Apple. So let's run over to the options grid, and let's see where Apple is trading at. Now, Apple is a little bit scary because a lot of people have been talking about the valuation. They think it's a little bit high for Apple, trading at a fairly high PE relative to the rest of the stocks that are in the S&P 500 index. I'll let those people debate that. But I'm more nervous about the marketplace. So you can take what we're talking about today. Nothing's meant to be a recommendation, as always on Options Guide TV. We're just trying to learn here. But you can take the concepts that we'll talk about today, and you can look at applying them to whatever underlying stock that you may own. So I'm going to take probably the most popular one that's probably owned by most of the people that would listen to Options Guide TV. And we're going to talk about buying a protective put on Apple. Now, the big question is, how far out in time do you want to go? And I do want to go beyond that magic date of when the potential government shutdown could be. So at this point in time, that's going to be the November 17th expiration, which is 42 days away. So when they kicked the can, it was 45 days away was the magic date that they kicked the can down the road to. Now we're looking at the 17th, and I think the shutdown date is November 11th. I have that number in my head, but I'll have to double check that. Okay, so here's November 17th. Now, these are the prices on Apple. And if I want to just do pure protection on Apple, the simplest thing to do is to just buy a put option. That's as close to buying car insurance as possible on your vehicle, right? If I buy car insurance, one thing that the big decision that I'm going to have is what's the deductible? How much risk am I willing to take? The more risk that you're willing to take on, the more the less cost you're going to have to pay for the actual policy. So in the Apple spaces, where let's call it 175. So if you go down 5 points, you're at the 170. So 5 divided by 175, that's a 2.5% or 2.9% move in Apple before your insurance would kick in. And so if you go down 10 points, you basically double that. You're looking at about a 6% move before your insurance would kick in. And then you also have to pay for the policy. So that's an added cost. So if you think of your car insurance, you don't drive your car around forever and then run it into a tree by mistake. And you're like, oh, you were right. I am a horrible driver. Please give me my premium back, right? Now, they'll give you a new car in theory, but they won't give you what you paid for your policy. So that's a cost of doing business. And in the protected put world, that's also a cost of doing business on Apple. And it's a real cost, especially on a stock like Apple. It's trading at a decent volatility. The more volatile the marketplace, the more expensive the insurance policy is going to be. And that's also, once again, an insurance contract. Like if you are a driver that has had many tickets, many violations, and also, had 2 or 3 accidents every 4 or 5 years, well, you're more of a risk as a driver to the insurance company. So in other words, you could say that your driving habits are more volatile than most people. And because of that, you're going to have to pay up for your car insurance. And that's also true in the stock market. We just call that implied volatility. So if this underlying stock has a higher propensity for movement, well, then you're going to pay more for it. For example, well, maybe it used to be a good example, but like if we're talking about Ford versus Tesla, Tesla was a much bigger mover, but Ford nowadays, they got a strike going on and things like that. But just think of underlying stocks that are in the concept of being in the same industry, but one is more volatile than the other, and you're going to have to pay for that. Okay, so we'll do the 170. We're going to go down 2.5 points, but here's the problem. That's $3.80. So you have $5 basically. Well, it's $5.50, right? Because the market right now is at 175.50. We're dealing with live markets. But we'll call that $5. And then the premium that we're paying for it is $3.85. So 5 plus 385, we're talking 885 divided by 175. We come up with 5%. So our total risk, if we bought this put, would be 5%. But we have to put up $3.85 for every 100 shares that we own of Apple. That would be $385 plus any commissions that you might pay. But if we do that, going out to November 17th, we know that we've probably got a decent gain in Apple if you have it. Apple has had a strong move even since the beginning of the year, but obviously over time. And the one thing that's really nice about this is we don't have to. We have the right to sell the stock at that strike. We could just sell the option contract if we wanted to, but we got the right to sell the stock at that strike. Doesn't mean we have to do it. All right. So that's what's nice about paying the money in the options world is we have a right, not an obligation to do that. So at this point in time, I talked about the real world movement. Let's go in and I'm gonna run over to Options Playbook and I'm gonna talk about a few other different little strategies and how we can combine them if you don't like the fact that you got to pay $385 to protect your 100 shares of Apple. There's always trade-offs. So let me jump over to that right now. One second. Let's go there for a second. All right, give me 2 seconds here. All right, let's go back to the playbook. And so if we look, first of all, here's the protected put strategy inside the playbook. Obviously, I'm the author of well, it's not obvious, but I am the author of the playbook. And here's the protective strategy. It just means that if I own 100 shares of stock and I buy the put with strike A, I'm going to have unlimited upside because the market can go, because I still own stock. Right? I didn't sell the stock. I didn't get nervous and go out and sell the stock. So I have an unlimited upside. But the put gives me protection from strike A on down. I can't lose any more of it. I'm going to move my break even up a little bit because I got to pay for that put. So that's a real cost. And I can add that into the cost basis of my stock and probably should if I'm thinking of this all correctly. But this is where I break even. If I buy that protected put, this is where my protection is. And I have unlimited upside protection. Now, that's great if you don't mind paying for options. But if you do, well, what can we do? We can do something to try to generate some income. Well, the next step that we can do is we can do a covered call. So let me open that in a new tab here. I had it all set up, but the website didn't really like that. So we open up this tab and we are long. Here's our protected put. Here is our covered call. And then lastly, what we'd be looking to do is a collar on the position. All right, where we combine all three of them. So on the covered call position, for every 100 shares, because right, we're acting like we have 100 shares of Apple. We buy that protected put. So then we sell a call. Well, we're selling a call. We're giving up some upside. So from strike A on up on our call, we do not participate anymore, saying that we're willing to give away some upside if the stock were to rally, means that we get paid now for saying we'd sell our stock later. So we can take that income and we can help pay for the put. If we do that, then we end up with a collar. Now, I'm saying you can do all of these strategies in one-off situations, or you can combine them. We talked about the flat-out protected put that we were looking to buy. Then we were talking about looking at a covered call to try to bring in some income on a stock that we own, just because we're, I'd say, more neutral in the marketplace, which has really been kind of my outlook so far. And then to go in and look at, well, if we can do all of this, we give up a little bit of upside, we can protect ourselves on the downside and have lower overall cost, and that's called a collar. So flip through these fairly quick. Here's what we're going to see, right? If we click on this and we look at the protected put, unlimited upside, limited and known downside, covered call, limited upside, unlimited downside. So you take the put, you put the call on top of it, boom, 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 and you end up with this. And that's the way the collar looks. So you're playing between strike A and strike B here on the Options Playbook website. And if the stock's in there, you're playing. But if it goes above or below, you're taking your ball and going home. You're not playing anymore. And so this is an interesting strategy for me, considering where the government is at and what we're doing, just the chaos of the marketplace that this is creating, the potential for the government shutdown. Okay, so now let's go and set all three of these up. We talked about the protected put. Let's find a way to add a call to that position so that we can pay for that protected put. And before I go back to the Trade Hawk options grid, I'm just going to put it out there. If you have any questions about any of these strategies, anything that we did on Monday or Tuesday, where we actually did a short spread on the call side of things on Monday on the SPY. On Tuesday, we did a short put spread, which created an iron condor. But that's kind of boring right now, that nothing's really happened in the marketplace. So maybe next week we'll come back and we'll talk about that one a little bit more. But if you specifically have questions about using options as insurance, please put them in the chat box. We'll try to address them here at the end of the show. So let me jump back to my original screen here. And I'm going to pull up the Trade Hawk software now. 1 second. See if I can do this a little bit more smoothly. And there we have it. And okay, let's go to the options grid. Here's Apple. We're targeting this date specifically. That's why we're going for November 17th. We are buying. Remember, don't forget, you have 100 shares of Apple. In theory, you have 100 shares of Apple in your account. We buy this put, fairly expensive, $385 on the midpoint, plus commission if you have to pay any commissions. For that protection on the downside, we're looking at about 5% when you throw in the deductible and the premium. That's your total risk on that trade. Now, what I'm going to do here, and I don't always do this, but I like the concept of a cashless collar. So quite simply, I'm going to go to the call side of things and see where I can find a price that is very close to the 390. And that's a little tough here. Now, if I look at the 180, which is 5 points up. Now here's the bid and the ask on the change. If I'm looking at the 180, we're talking about $4.25. If I look at the 185, you're talking about $2.43. So unfortunately, we're right in the middle, right? So that makes it a little tougher on your decision. To do it as a cashless collar, we would do the 185 and actually bring in a credit for our insurance product. And then we actually have the same amount of downside as we do upside, right? We're going to say the stock's at 175. You have 5 points of upside on Apple going into this big event versus 5 points of downside. And you're literally just playing right in between the strikes. It kind of helps out that the stock's right at 175. But what's nice here is that you actually receive more for the call than you are for the put. And that would be a small credit. So I'll start by clicking on that one. And let's see where that credit is. So we're bringing in a 40-cent credit to insure our 100 shares of Apple if we do that. That means we're going to put $40 in our pocket. Our opportunity risk is there. If it goes above 180, we'd have to give up any upside on that potential. And our risk is capped to the downside if it goes below 170 in that scenario. All right. I personally would probably pay a little bit for my insurance. And because I'm more worried about, I own Apple at a very low price because I've owned it forever. And so I don't want it called away. So what I'm going to do here is I'm going to remove this strike and I'm going to pay something for mine. So I'm willing to pay $1.36 as opposed to $3.85. So I'm going to take a little bit of the profits that I had in Apple to protect it, and I'm going to pay $136 for my $5 deductible insurance policy, if you will. But now I'm giving up some upside from 185 on up. So at this point in time, that's the way that I would probably approach it. I don't mind paying for a little bit of protection on my Apple position. Now, this can be applied to any other underlying stock. And if you have one that you'd like to look at, I'd be happy to do that if you want to throw one in the chat box. But Apple is, like I said, one of the most widely held stocks by almost everybody that owns a brokerage account. They have it in some type of retirement in some way, shape, or form. All right, so let's actually now go and add stock. We're going to add 100 shares of stock to Apple, and we're going to go to the what if calculator. And I'm going to show you a lot of the same things you saw inside the Options Playbook website. So if we go to the what if calculator, and we see exactly what we were talking about. Underlying stock is right here. No, last trade was 175. Okay, our underlying stock is right here. Basically, that's where our break even is as of right now. On the way up, we have limited and known upside all the way to 185. On the way down, we have limited and known downside all the way down to 170. We're only playing in between the strikes, 170 and 185. And we have this going out until the November 17th date. That's the magic day when our option contracts would expire. And ideally, if I put a trade on like this and I own Apple, I'm only nervous about the upside. If it's going on the downside, I'm probably going to sell my put, and as opposed to exercising Apple. And I can decide when I want to sell that put. If it gets down to the 170 to the 165 range, I could decide where I want to actually sell the put and get out. On the upside, though, we have some nervousness, right? Because a lot of people own Apple at a low cost basis, and it's that simple. And I don't want to get called away and have that capital gain. So I'm going to pay a lot of attention if the stock starts creeping up towards 185 before this expiration date of November 17th on this position. And if it gets to there, I'm either going to take the whole thing off, I'll sell my put and close my call, or I may roll my call option contract in order to do that. And that would actually be that position that I would put on. All right. So I do see we got a question that popped up in the chat box. Let's put that up on the screen. Would you ever consider spending a bit more to buy a put with a longer expiration than the call, just in case? Would I buy it? The short answer is going to be no. Okay. So the short answer is going to be no. And the reason why is if I buy the protective put, I don't usually want to go. Let's just say I'm just buying a put outright. Would I rather, let me rephrase the question. I like the question a lot, but let's rephrase it and just focus on the put and say, would you rather buy a 90-day put or a 45-day put? And in my mind, I'd rather do the 45-day twice as opposed to doing the 90-day once. And here's the reason why, is that if I put the put on, I'm still bullish on the stock. And if I'm right and the stock market goes up, right, I'm just buying protection. That's all I'm doing. My best case scenario is that the stock continues to go up because I own the stock. So would I rather do a shorter term put? If the market goes up and all of a sudden it's up 5%, well, now I'm 10% out of the money on my put in our example with Apple, right? Or let's say it goes up 12% or something like that. Now that put is really not providing the protection that I would want. And so if you go further out in time and you do a 90-day put, well, that means you probably got to sell it and roll it up. So I personally would rather do short-term puts, even though in short term is relative, right? 30, 45 days. We got a specific date that we're targeting. So I would rather do that and just buy 2 puts. And then I can target what strike I want and how I would adjust it. Now, then the question becomes, should I buy puts all the time? No. If you're buying puts all the time, you should just sell the stock. It's that simple, because you obviously don't think the stock can go up. You're buying puts because of a specific situation. And this is what Options Guy TV is all about, is we have something that we're nervous about. So that we are going to protect some of our stocks. We're either going to buy a put outright, we're going to sell a call against it, which would be a little less protection, give you a small pillow to land on if the underlying stock goes down, or we're going to collar it. And these are the 3 ways that we're going to approach it. So I thank you for your question. But that's the way that I would approach it. Okay, so now we're going to go back and look at this trade. And this is how Apple would be. We got the underlying stock that's in it. But remember that most people would have this in the portfolio. So all we're doing is putting on the put and we're putting on the call. And so if I run back and I look at our strategy here, my biggest concern is if it gets to 185. If it gets to 185 before that expiration date, I'm got to do something with this position. Now, some people would be okay with selling it. There's some people that are saying you should be selling Apple right now anyways, because the valuation is too high. I think it's a little bit more September and October that scares people, but I don't want to try to time the market with Apple, if that makes sense. I'm not an Apple market timer. It's one of the biggest companies in the world, and I just want to own some of it. Maybe be the biggest. It swaps around every once in a while. All right, so let's go to full screen, and I'm going to try this again. I'm going to give you some required homework if you're nervous about your Apple or whatever stock you're looking at getting called away. So there we are. And let's try this a little better, see what happens. There we go. Now it worked right. All right. We're back. So if you go in, and I'm actually going to blow up the website here a little bit. I'm looking at it on the screen and it's not quite filling the whole page. So I just zoomed in a little bit. And this is the collar. Strike B would be the covered call in that position. If you're worried about it, you want to read this under managing positions inside optionsplaybook.com, rolling a covered call. It gives you hints as to when you want to roll, how you want to roll, how you pull it off, what you want to think about. But the moral to the story here in this section under managing rolling a covered call is if it goes beyond your strike, it's hard to roll and get it done for a net credit. So if anything, you want an alert, you want to notice that when it gets to, I think it was 185 that we were looking at on our last collar. When it gets to 185, you need to make a decision then. Are you going to roll? Are you not? What's your outlook on the underlying stock when it gets there? Because if you wait too long and it gets to 190, well, now you're in a situation because there's no way that you're going to be able to roll up and out on a shorter time frame and get it done for a net credit to the account. And that's the whole goal of doing a roll, is to try to get it done for a very small debit, but I'd prefer to do it for a net credit. And if you do it while the underlying stock is close to the strike, you can pull that off. And I look at the clock here and it looks like we are 1 minute past our normal time. So if there's no other questions, which I don't see any in there, I think that's going to be it for this edition of Options Guy TV. I love the fact that we had an opportunity to talk a little bit about protection in the marketplace. And if you could click subscribe, ring the bell so you get all the alerts for Options Guy TV, and then also pound that thumbs up. That helps us a lot here. And we'll see you this coming Monday at 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for coming, everyone.